When a small-cap semiconductor company suddenly raises $25 million at a fixed price of $5 per share, you need to ask one simple question. Is this smart strategic funding or silent dilution hitting shareholders? Because in the stock market, offerings can either build the future or quietly transfer value away from you. Today, we're breaking down exactly what Atomera Incorporated just announced and what it actually means for Atom stock. On February 23, 2026, Atomera announced it entered into a definitive agreement with institutional investors. They are selling 5 million shares at $5 per share. That equals $25 million in gross proceeds. The deal is structured as a registered direct offering, and it's expected to close around February 24, 2026. The sole placement agent? Craig Hallam. Now pause here. This was not a public ATM offering. This was not retail-driven. This was institutional money. That distinction matters. Let's simplify it. A registered direct offering is when a company sells shares directly to institutional investors using an already approved shelf registration. In Atomera's case, that's their Form S-3 shelf filed with the SEC. No roadshow, no broad marketing. Just negotiated institutional capital. This is often faster, and usually priced at a small discount. So here's the psychological tension. Institutions stepped in, but existing shareholders get diluted. Both can be true at the same time. Yes, technically issuing 5 million new shares increases the share count, which means earnings per share, ownership percentage, all get slightly diluted. But here's the deeper layer investors miss. Dilution is bad, only if the capital doesn't create more long-term value than the dilution cost. If $25 million accelerates growth, partnerships, or licensing revenue, then the pie gets bigger, and your slice, even if smaller percentage-wise, could be worth more. That's the bet. So, Atomera isn't a traditional chip manufacturer. Instead, they're a semiconductor materials and licensing company. Their core technology is called Mears Silicon Technology, or MST for short. MST improves transistor performance and power efficiency. And here's the key. It actually works with existing semiconductor manufacturing equipment, which, really lowers adoption barriers. If major foundries or chip makers decide to integrate MST into their production, Atomera doesn't need those billion-dollar fabs. They just collect licensing revenue. That's a pretty high-margin model, but, well, it does require time and capital. The company's stated proceeds will be used for working capital and general corporate purposes. That sounds generic, right? But in small-cap semiconductor tech, working capital often means funding research and development, supporting customer qualification cycles, and, well, just extending runway during commercialization. Institutional investors don't randomly write $25 million checks. They evaluate runway, adoption probability, and tech positioning. The fact that this wasn't a distressed financing at a deep discount tells us something important. The price was set at $5, not $3, not $2. That suggests negotiation power wasn't completely lost. Here's how retail traders usually react to offerings. Stock drops, fear spikes, social media screams dilution. But professionals ask a different question. Does this extend the runway enough to reach the next catalyst? Because if the company runs out of cash, that's catastrophic dilution. Raising capital before you're desperate, that's strategic. The market will likely test support near the offering price. Why? Because $5 just became a reference valuation for institutions. That level now matters psychologically. Let's think like investors, not gamblers. Bull case. $25 million strengthens the balance sheet, institutional participation, high-margin licensing potential, and, of course, semiconductor industry long-term growth. Bear case. No guaranteed commercialization timeline, dilution pressure, revenue still dependent on adoption. This is a classic asymmetric small cap setup. High upside if adoption happens, high volatility if timelines slip. So instead of asking, is this good or bad? The better question is, do you believe MST will be adopted at scale? Because that's the real driver. This wasn't a bankruptcy financing. It wasn't panic. It was a calculated $25 million capital raise, and now the pressure shifts, not onto investors, but onto execution. Atomera has the cash. Institutions are in. The technology is proven in silicon. Now comes the part that separates story stocks from scalable businesses. Watch partnerships, watch licensing announcements, watch cash burn rate. Because the next headline won't be about dilution, it'll be about adoption, and that's when this move will make sense, or not.